Welcome to this highlight of AARO Academy's training on IFRS 3 business combinations, where we give insights into some of the pain points when reporting a business combination based on IFRS 3. Our aim is to debunk some of the difficulties experienced while reporting business combinations. In the end, we will have shown you how we simplify them during our IFRS 3 training and make your reporting a non-event. While a number of standards inform group accounting under IFRS, the business combination standard is critical when identifying the acquirer and acquisition date, deciding which acquisitions to consolidate and those to be left out of the consolidation. Of course, the goal is to confirm that the acquired asset meets the definition of a business, which includes assessing if there are inputs put into substantive processing that results in outputs, recognizing and measuring assets acquired, liabilities assumed, and the non-controlling interest. Finally, determining if the subsidiary was acquired at a profit or loss, what IFRS 3 refers to as goodwill or bargain purchase. Under IFRS 3, determining whether the acquired set of activities and assets should be accounted for as a business combination or an asset acquisition may be judgmental, hence the amendment to IFRS 3, to remove bias that may arise due to judgment during the assessment by applying an optional concentration test to permit simplified assessment. Where the test is met, the scenario is treated as an asset acquisition and no further assessment is required, therefore such assets are not consolidated. According to IFRS 3, as amended, a concentration test is met if substantially all the fair values of the gross asset acquired is concentrated on a single identifiable asset or groups of similar identifiable assets. In AARO Academy training, we illustrate using practical examples, detailed approach to the concentration test when an entity decides to take the option, amongst other salient features brought about by the amendment applicable from the 1st of January 2020. IFRS 3 dictates that at the date of transition acquired assets, assumed liabilities, and non-controlling interest be measured using fair value. This can be quite challenging. To be specific, measuring fair value of intangible assets can pose a challenge on items such as trademarks, patents, and customer relationships, and may need specific expertise and significant judgments. AARO Academy supports this through its detailed and practical training on IFRS 13 fair value measurement. Secondly, where an acquirer does not get absolute control and shareholders with non-controlling interest arise, measuring the fair value of non-controlling interest adds to the difficulty. While negotiating a buyout, the acquirer normally incurs some costs that are directly related to the acquisition, since the acquired subsidiary is consolidated from the acquisition date. The question has always been whether to include such costs in your consolidated financial statements, and if yes, where. The standard allows acquirers to expense such costs as incurred rather than capitalize them. This treatment negatively affects the profits in the year of acquisition. Moreover, the costs were incurred at a time when the revenues from the acquired entity could not be consolidated. It may also be difficult to track and separate acquisition-related costs from other operational costs and expenses. Before continuing talking about IFRS 3, I'd like to invite you to AARO Community. Join us in discussing the latest trends, hot topics, challenges, and best practices in group accounting, group reporting, and financial consolidation. Share knowledge and learn from one another in a supportive and inclusive environment. Whether you're a seasoned professional or just starting out, AARO Community will be a valuable resource for you. Let's grow together and build a strong community that elevates the fields of financial consolidation, regulatory compliance, IFRS, and much more. Welcome to AARO Community. A reverse acquisition occurs where a business combination is effected using equity as consideration, and the entity that issues securities, also known as the legal acquirer, turns out to be the acquiree for accounting purposes. A challenge therefore arises in identifying the acquirer. In addition, IFRS does not provide specific guidance in IFRS 3 to account for common control transactions, leading to reliance on other frameworks and optional decisions on applying IFRS 3. This results in inconsistency, making comparability difficult. Our Academy relieves you of this challenge by giving in-depth training on the available accounting policy options regarding accounting for mergers. Where contingent considerations are paid to acquire a subsidiary, calculating goodwill becomes complex considering the contingent nature of the consideration amongst other variables. That, notwithstanding, a reporter will again face challenges in setting up mechanisms for annual goodwill impairment testing, as it is intense and requires subjective judgments, for example, assumptions on future cash flows, the rates used to discount them, and the anticipated growth rates. While IFRS 3 aims to streamline reporting of business combinations, there are several implementation challenges that haven't been exhausted in this presentation. To conclusively address these pain points, a reporter needs to understand in detail the complex requirements of IFRS 3, valuation requirements in IFRS 13 fair value measurement, goodwill impairment testing, extensive disclosures requirements, amongst others. The good news is that AARO Academy offers detailed technical but practical training on all these subjects as part of the group accounting suite of standards. Thank you for joining AARO Academy. We value your support and would like to invite you to subscribe to our YouTube channel for more insightful content and updates. Thank you.